Why start it?
Welcome, everybody. We'll give everyone just a moment to get in the room, so to speak. Welcome to our fourth quarter economic and market update this for Asset Management Resources. Glad to have you all with us. Before we get started, I'll just mention a couple of things that I want to remember to mention to everyone. It's been a great a great year so far this year. We're going to talk a little bit about what's been happening, how we did last quarter, and look ahead for what we might anticipate. I want to remind everybody that it's really important that we take a look at your portfolio in the context of the overall financial planning. And if you need help in that, just let us know. It's also the time of year when we start thinking about required minimum distributions. So if you haven't taken yours this year, we do have to take them for those who are 72 and over, and those who have beneficiary IRA. You do have those distribution requirements for those who have lifetime distributions. We'll be talking to our clients throughout the quarter to make sure anyone who hasn't taken it has a game plan. But if you know it's something you'd like to do, feel free to reach out. We also, this time of year, often will think about year-end planning. There's good news and there's bad news. The good news is markets have been very good. The bad news is, as a consequence, we don't have a lot of losses that we might try to utilize to offset some gains here and there. So we'll want to talk to you if you have any questions about your capital gains picture. If you're worried about markets, it's always a good idea to review your risk profile. And we like to remind everyone of that, particularly on these calls. So if you have uncertainty or anxiety about the way you might be positioned, certainly reach out. We're happy to talk to you about making sure we have the right strategy for your needs going forward. With that, let's review what's happened and what we might be looking ahead to do. Joining me for this call is Brian Regan. He is our Chief Investment Officer. He will be providing the bulk of the commentary for our comments today. And we're really glad you're here with us.
Here as usual.
Thanks, Brian. This program, we're going to certainly review what we've talked, sort of what's happened over the last quarter, how performance has worked out, what's happened in the markets. We'll be looking ahead as well, more importantly, as to how we see things shaping up. All of this will include some context for what's happening with COVID, worries about inflation, what that means for growth, equity allocations, how we've structured our portfolio, both in the stock and the bond side of things, and some bottom line takeaways for you. So with that, let's dive right in. Starting with a review of last quarter. I think we went into this quarter with the expectation that we were probably well positioned with the way we structured things in the second quarter, and that there wasn't a whole lot we really wanted to change. That was good for us ultimately, because we did have a limited exposure to China and some of our emerging market exposure. We had overweight in areas like real estate and consumer discretionary, and all those decisions did help in providing a little bit of outperformance throughout the quarter relative to our alternative, our benchmark, or whatever it might have been at different levels of risk. Anything else you want to say on that, Brian, before I go on to the next slide?
I think you did a good job, Chris.
All right, let's just point out, look, the markets have been great year to date. This was a picture of that performance. There's two columns at the top. Really, the one that says VAL, the value as of year to date, is what we're looking at. And it's pointing out that real estate has been an outperformer, which, as we just said, we had an overweight position going into throughout the quarter in real estate. So that's been a good move for us. Of course, stocks in both large cap and small cap have really done well. And it's been a great exposure just to be in the market, really. We had intentionally underweighted our international exposure, particularly in the emerging markets. And, those have been good decisions. We've seen better results from US markets and particularly underweight in China, and that's been good for us going through last quarter and throughout the year. When it comes to bonds, you can see that the aggregate bond index has been a little bit of a drag on the markets, relatively speaking. We've been a little bit better positioned in the way we made some decisions around the way we structured our bond positions, so that we've outperformed that aggregate bond index by and large across the board. So
the only thing I would add there, Chris, is that we actually have positive performance from our fixed income, and this chart shows on average this negative performance. So
it's a really important thing, because I
part.
think, yeah, to your point, Brian, a lot of people are worried about, particularly when they hear about risks of rising interest rates and these kind of concerns, should they have bonds? And it's always important to remind people the reason we have bonds more than anything else is because they're not stock. They have a lot less volatility even when they have some bad times. And we've been positioned in a way that has gotten them positive results and a good buffer to volatility just in case. So let's look ahead. Brian, why don't I turn things over to you and let's talk about the next quarter. What's our expectations as we look ahead?
Sure. So I think this is a great way to start it, just asking yourself, what's the story? What's going on? And we all know that the pandemic has been weighing on everybody's minds and on the markets for a long time. And the good news is it might not feel like it on a day-to-day basis, but progress is being made on the pandemic. We're going to show you data on all this, obviously. Growth is slowing. Inflation continues to be elevated with spikes and resets. So we've seen that through, last quarter we were seeing it through lumber and copper. Now we're seeing it in gas. And so these things seem to spike and then settle out. And that's kind of been on a rolling basis. And, I think we could expect that to continue a little bit. Unemployment continues to improve, but there's some structural problems that are keeping us from getting to where we need to be. We've benefited from when it comes to our equity allocation, we've benefited from our consumer discretionary sector. We want to diversify a little bit this quarter from consumer discretionary into mega cap tech, because it's presented an opportunity in there more recently. And the tightening policy makes longer term bonds more expensive relative to shorter term bonds for the first time in a while. So the last time that we were in this situation was probably in early to mid 2018. It's been a couple of years since we've been in this situation. Generally speaking, I usually like to target a longer part of the yield curve, but we're going to bring it in a little bit this quarter. We'll talk about why. The limiting of longer term bonds forces us to limit risk taking in other areas of the market. Primarily, we're going to diversify away from real estate and credit, which has served us well for this reason. And overall, I think we're going to have a less risky portfolio than we've had in the recent past and going forward. So here's some data on COVID. These are just cases straight from the CDC. You can see that we had the elevated spike, and then we got it at the beginning of the year, and then we had the dramatic drawdown from the introduction of vaccinations. And then we had another spike because of COVID, and now we're seeing a drawdown there. And why are we seeing the drawdown? Well, the reality is about 85% of people now have some form of immunity. 76% of people ages 12 years or older have at least one shot of the vaccine. And then, unfortunately, a number of people have some natural immunity from being infected as well. And then some people have both. So in this chart, we're seeing the vaccinated only is the green line. The estimated that have been infected and vaccinated is the gray line. And the estimated infected only is the blue line. So we are getting closer and closer to, hopefully getting past this. I know I've been a broken record on that for the last year, and maybe it's hope on hope. But generally speaking, I think The economy has continued to press forward, and we've learned to live with this to a certain degree. Now, what does this all mean for inflation and growth? I think this has been, the top headline item recently, and for good reason. And it's all due to the effects of the pandemic and the response to the pandemic, which has been a kind of a fun roller coaster to watch and to monitor. So let's talk about what's happened recently with money supply growth. We saw huge spikes in the money supply growth as the Federal Reserve responded to the pandemic. They did not want there to be credit issues during limited demand during shutdowns in a pandemic. So we saw huge spikes in the money supply growth. We've seen more recently rhetoric come out about tapering, and which will lead to eventual increases in interest rates over time if everything goes to plan. And that is dramatically, just the talking about it has dramatically brought down the growth in the money supply. It's important to point out this isn't a money supply chart. This is a growth in the money supply chart. So you'll see that the growth in the money supply is still elevated from historical levels, at least the last decade. So, we're still being accommodative, just not as accommodative as we were. And I think that's a significant difference.
Brian, just for our audience, make sure they understand what that means about money supply. This is related to the Fed. Is this related to consumer? Who's doing this? Where is this coming from?
Yeah, so money supply, the good way of thinking about this is liquid assets that are available to people in the United States. So it all kind of starts with the Federal Reserve. They dictate interest rates, short-term interest rates. They dictate how much banks need to hold at the Federal Reserve and what interest rate they're going to pay on that. And all that determines how much the banks lend to people. And there's two ways that people can spend money. They could do it through credit, and they can do it through dollars and cents. So if you want to limit the money supply, what you essentially do is you limit the availability of credit. And that's really what's happened here. So banks have slowed down their how accessible they are to lending money. And it's just it's very similar to just saying that interest rates have gone up a little bit.
Okay, thanks.
Yeah. So we're talking about a lot of talk about inflation. We've seen core PCE level off, which is a good thing. There's a lot of headlines where it comes to inflation. The Federal Reserve cares about core PCE, not necessarily headline CPI, which came out today at 5.4%. Core PCE excludes food and energy because they're typically very volatile. And what we see is that there is a leveling. There has been some commodities that are kind of stable to normal, some commodities that are experiencing huge spikes. The bulk of the change in core PCE has been due to a huge spike in price of durable goods. So these are your cars, your washing machines, things that tend to last a longer time. And I think the main reason for that is the well-documented shortage of semiconductors. So when that starts to be cured, I think we'll be in a much closer place to being in a normal inflation environment. And the new normal might be a little higher than what it has been in the historical past, which is okay. In fact, the Federal Reserve has said that that's something that they would like to target, because inflation has been lower for the previous decade than they would have liked it to be. So, on net, they will be closer to their 2% target. And this has been a recent change that happened about 2 years ago in the Jackson Hole Conference, where they said they'd like to average 2% rather than have a target of 2%. So inflation is elevated, but not necessarily a huge concern. We do think, in time that this could get closer to a new normal. The new normal will likely be elevated from the historical past, but that doesn't necessarily mean that it will be detrimental to the economy. Now, it is certainly worth monitoring. I think it has lasted longer than most people expected. And I think some of the spikes and resets have been more dramatic than people have expected. But all in all, I think we are, in the place kind of what we expect it to be. Now, unemployment, this is a big one. We're dealing with a structural problem in unemployment. There's, even though we're at a very healthy unemployment rate, where the historical average has been around 5.2%. Before the pandemic, we were at 3.8%. We saw wages rise kind of naturally because people were, the employment market was hot, and that was a good thing. Now we're seeing about 11 million people that could be working aren't working. And that when you put together the employed versus the unemployed versus people who fall out of the labor force, you get to that 11 million job number. And that's similar to what the JOLTS open jobs number is. So if we could match these people to jobs, that would be fantastic. Now, the problem is we're still, this is still one of the effects of the pandemic that we're dealing with. And I added the US labor force for married people in the bottom part of this chart. I think, obviously this isn't true for everybody, but married people tend to have families and children. And I think this is pretty clear when you see almost 3 million people haven't come back to the labor force. A big part of this is due to people looking for childcare. There was, speculation that the additional benefits were part of the reason. I think it's pretty clear that childcare is a big issue here. I also think people are retiring, so we're gonna see a big issue there, where the baby boom generation was aging into retirement anyways, have used the pandemic as a very valid excuse to say, hey, look, maybe now's my time. And we're all these things are kind of coming together at once. That with an elevated savings rate as well, where people don't necessarily need to go back to work yet because they have more in their bank accounts. And I do think these things will work itself out over time, especially as the pandemic eases, especially as wages rise. But it could be choppy. The most recent jobs number wasn't a very good one. And I don't think that's totally unexpected, especially given the fact that, growth in the third quarter has some wild estimates one way or another. And we'll get into that. So this is this is a complicated chart, and I'm just going to explain it. This is bad news. This is what the Atlanta Fed is expecting in a more real-time basis of what they're expecting for GDP to be in the third quarter. And their most recent estimate was only a shade over 1%. So, we've been running 6.7%, 6%, et cetera. It's like 12% on a trailing four quarters average. We've seen some historically high GDP numbers in the most recent quarters. So a 1% would be under what our normal run rate would be. So you can look at this two ways. This is a kind of a normalizing of GDP numbers, and that's an inevitable slowdown, or you could say that this is a kind of a red light for consumer spending, durable goods spending, inflation, kind of a stagflationary environment. I think this is just something that, maybe people get a little irritated with me saying, but this is something that needs to be monitored. I have very conflicting data on the very next chart. This is from the New York Federal Reserve. This has slowing GDP as well, but this has slowing GDP around 6.5% for the third quarter. So I got one estimate that says 1%. I got one estimate that says 6.5%. The long-term average is 2.5%. We have a huge divergence in what these estimates are. And these are, some of the best economists in the world trying to guess at this. So what does this tell me? We're having a slowdown in GDP. They both agree on that. It could be really, really bad, and it could be gradual. One thing's for sure is what I think is going to happen is we're going to have, when earnings come out, we're going to have haves and we're going to have have-nots. And that's part of the reason why I wanted to get out ahead of our changes this quarter before earnings season started. So let's talk about it.
Just as a follow-up on that, Brian, given this potential slowdown in GDP, are you worried that we're moving toward a recession? How worried should investors be as it relates to that?
I don't think there's any sign of that. So right yet, a recession is 2 quarters of negative GDP. Even in the worst case estimate here, we're not seeing a negative GDP. We're still seeing 1% GDP. And you do need to take it into context of what the previous quarters were which were far above trend. You could make an argument that 1% GDP could be a relatively good thing, as it could bring down inflation for a quarter before we reset to our new normal. I don't think you can say any of these things with any certainty. And I'm a big believer in what do we know for certain, what is actionable, and what we know for certain is that we're likely going to have a slowdown in GDP. It's going to be gradual, most likely. It's going to be somewhere between gradual to more extreme to choppy. But let's act on what we know is to be true rather than what we speculate could be the worst possible thing.
Thank you.
So let's talk about our equity allocation. So how are we going to take all that and move it into an equity allocation? Chris usually does a good job of presenting this every quarter, and I'll give a shot at it this quarter. We've actually seen stocks get cheaper, despite the outstanding performance that we've had in the stock market this year. On a PE multiple basis, they've gotten cheaper. For every dollar you spend, you're getting a bigger proportion of earnings when you buy the S&P 500, at least on a forward basis. So forward estimates could be wrong, but we saw these sky-high PE ratios. And what we expected to happen was, as earnings came in and earnings estimates went up, the PE ratio would actually go down and the stock market wouldn't react. And we are seeing that if you look at this chart. So the chart on the right shows the blue line going down. That's the PE multiple actually falling. The gray line is earnings growth. We've had 27% earnings growth year to date. And the green line marries the two and gives you price return. And when I pulled this chart, it was 16.1% in S&P price return. So you can see that the elevated earnings growth has actually, propelled the S&P 500 forward, which is what we said needed to happen because we expected the multiples to fall as interest rates rose and money got a little tighter. So we talked about money getting a little tighter in the previous segment, and this is kind of where that fills in. So this is good news, right? We've stock market hasn't really fallen too much, really at all. I mean, a little bit off the highs, but it's had an excellent year. But stocks are cheaper. I mean, it's best of both worlds. So, this is kind of related to those GDP charts. What has been the trend? We've seen U.S. retail sales growth. It's been excellent. 13% year over year. Durable goods sales growth 14% year over year. So this is why we're having those inflations and this inflation and supply chain problems and shortages. It's because people want to buy stuff. There's a lot of demand, and people literally can't get into the country and into the stores fast enough. So in the short term, I would say this is a good thing, and I would expect it to continue. And I would expect it to continue mostly because of this chart. This chart shows U.S. personal outlays in the purple line. U.S. personal current transfer receipts, which is essentially government giving people money, and we can see that's been elevated. And then the blue line is U.S. personal savings. So you can see that the personal savings get much more elevated when the government pays people money, but the United States consumer is very good at spending that additional money. They have no problems doing that. And the savings rate's still elevated by about $500 billion. And that can filter into a lot of continued consumer spending in the economy. So, what does this mean for our equity allocation? Well, we've been in consumer discretionary positions, and we've been in consumer discretionary positions because this blue line's been so high, because those orange lines have been elevated. And what we're seeing is the time is coming to an end for that, but it's not over yet. And that is why we started to reduce it a little bit. And we're going to replace it with what this chart's showing us. So this is really the valuations of the mega cap tech names that we're familiar with, Apple, Facebook, Google, Microsoft, and Amazon. We've seen these stocks have incredible performance, yet they're still cheap, relatively speaking, especially Facebook. We all know why with Facebook, but they're all relatively cheap. And this is, feeds into that original PE ratio chart that we were showing from JP Morgan that shows even though these stocks have gained, they haven't gotten more expensive, and we should celebrate that. So this has shown us, given us a bigger opportunity as of late, and with kind of diminished confidence is a good word to say it with the consumer discretionary. It's a good way to kind of diversify our portfolio away a little bit from those names. Now, I want to show this one last chart on wage gains. This is, both inflation related and consumer discretionary related. We're seeing people that get paid hourly get dramatic increases. And I think this is a great thing to see. We're starting to see it over 4%. We saw that prior to the dot-com bubble, it was around 5%. So there's still a lot of room to go before we get to the heights of where people were actually making significant wage gains in this country. But it's starting to trend in the right direction. So people who tend to spend the money are getting paid more and getting some bargaining power in the office. Now, the blue line is prime age workers, and prime age workers is typically defined as ages between 25 and 54, and their pay isn't going up. It's actually stagnating. So, this is a little bit cause for concern. And I do think this plays into that married with kids theory that I was espousing earlier when it comes to COVID. And hopefully this changes with time as COVID eases. So we've been in a small cap position for about a year now, maybe a little bit over a year, maybe 5 quarters. And it's been a very, very good position for us. But as of late, maybe the last 6 months, it's stagnated a little bit. And that stagnation, I think, I'll say is healthy, but it's also, it's allowed for the opportunity to remain there. This chart shows the S&P 500 is the red line. The S&P 600 is the small caps. And you can see the difference in the PE ratios. The S&P 500 has one that's over 20, and the S&P 600 has one at under 16. And we can see here from this chart that there's no shortage in earnings growth expectations for the small cap stocks. So when earnings growth is significant, you would expect it to have a more elevated PE ratio. This is just a good way of saying that these are still relatively cheap, and barring maybe the worst case scenario in that GDP divergence that we saw, I'd expect continued performance from the small cap stocks. So let's talk about fixed income. I think it's important to note that when we talk about our fixed income strategy, fixed income is far less volatile than stocks. Being overly concerned about fixed income is like versus your stock portfolio is like being worried about skinned knees when you could be going to the hospital in terms of risk. And I think that's really important to point out to people. And that's why we, typically for most of our clients, except for, younger earning, healthy financial plan people, we want a significant portion of their portfolio to have a fixed income allocation. So, I just wanted to preface that because I think it's an important reminder, and it comes up a lot. So this is the yield curve. This is what the U.S. Treasury pays on debt. If the U.S. government borrows for 1 month, they pay almost zero. If you borrow for 30 years, you pay about 2%. The blue line is the latest close from when I pulled this chart. The red line is 6 months ago. The yellow line is 1 year ago. So you can see over 1 year, the yield curve has steepened. So what does that mean? Well, it's great for banks, right? So if you're a bank and you pay deposits on kind of an overnight rate, you're paying zero. And we all know that because we all have bank accounts. And if you're lending on a mortgage, you're probably lending around 3.5%. And that spread is something that they make money on. But this is also a good way to determine where you are going to get the most bang for your buck for your fixed income securities. So the general rule of thumb is you want to invest on the steepest part of the yield curve because that's where you're going to get paid the most for the least amount of risk. That trade-off is going to be the most ideal in that situation. So if you look at this chart, you can see that it starts to pick up a little bit between the 2 to 3 year month, and between the 3 to 5 years, that blue line is the steepest. So we've been around 4.5. We've been on the longer end of that steep part of the curve. Now we're going to move to about 3.5. And I think that's a slightly less risky way to continue to where I think that we'll continue to have positive returns in the fixed income portfolio. Chris started off this conversation by, talking about how the aggregate bond index has actually been negative 1% for the year, which is over a historical time frame. That's a very rare thing. And we've been positive, and I'd like to continue that positive momentum by taking a little less interest rate risk going forward.
Brian, can I just ask you before you move on?
Yeah.
What does it imply when you see on the last slide that the yield curve is maybe a little less steep than it was 6 months ago? Is that anything to be? What does that imply to the consumer, to the investor?
So if you remember 6 months ago, it was before the Delta variant, right? So there was a little bit more optimism in the economy. And when there's more optimism in the economy, the yield curve tends to get steeper. And a steep yield curve is actually usually very bullish for stocks. Then we had the Delta variant. You might remember that we had a kind of a dramatic sell-off in yields, and the yield curve got flatter. Now that we're coming out of COVID, I'm not the only person that has that CDC data. We're starting to see that steepening again. So, that brings me to this next chart. You can see that, let's concentrate on the purple line for a second. You can see that through the beginning of the year, the total return on the kind of longer term strategy that we have didn't do very well, because we saw that increase in yields that we were just talking about. And then when the Delta variant concerns came, it actually performed exceptionally well. So, we had a conversation with a client just yesterday, Chris, who said, I don't understand. You told me that we shouldn't worry about interest rate risk. Now you're telling me you're taking less interest rate risk. And well, last quarter, if you follow this chart, we were at a opportunity point to be in longer term bonds. So we continued to be in longer term bonds. And if I were to stretch this out, just chart out even further, the total return on longer term bonds is going to surpass short term bonds. Even if I just go out 10 years, I know that on average it's about 1.5% per year better. Now, if we look at the top orange bar there, the gold bar, you see that we've been more consistent. We haven't exactly been shooting the lights out either with 1.43% year to date, but it's been positive and it's been consistent. So now that the opportunity set is swinging a little bit, right, where we're seeing COVID become less of a problem, yields rise. I want to be less in that purple line, because I expect what happened in the winter to be more likely to happen again, and move more into that orange line, where it's going to be that steady eddy, but it's over the long term, it's not going to be as profitable.
And it's relevant to say this is a tactical positioning where it will change with time.
Yeah. So if we see, if we see a dramatic change in this purple line, if the yields go back up to, let's say, 2.5%, well, I think that could, all things equal, that could present an opportunity where we'd want to extend risk a little bit. And this is, doing these small changes is how we manage to get positive returns when the average bond index is negative for a year.
Thanks.
Now, one of the challenges of getting a little shorter in interest rate risk is you have less of a ballast to your portfolio that you would have if you were in longer term bonds. Because historically speaking, when stocks sell off, bond yields sell off and bonds rise, and it's a diversification benefit that you get there. Now, I get less of that benefit if I'm in the shorter part of the curve. I get more of it the longer I am out. So since I'm shorting up, I need to take less risk elsewhere. And what the next couple slides is going to show us is that we're going to take that less risk in our credit bond portfolios, which are significantly more risky bonds, which we talked about on the radio show last week. I encourage anybody who wants kind of a deeper dive into what a high yield bond is to listen to that last show or podcast. And we're going to decrease, actually, we're going to eliminate in most of our funds, or most of our strategies, our real estate position. So this slide is about our real estate position. So I want to concentrate on the purple line. The purple line is the fund that we've been in. It's a combination of preferred equity shares, mortgage-backed securities, and just straight equity REITs. The blue line is more straight equity REITs. The orange line is more commercial mortgage-backed securities, the third part. And the green line just shows US rental income, which I think is a surprising point that it's been negative for a sustained period of time. I think there's a lot of headlines about how rent is going up, but what we've seen is on average across all the US rental market, it's actually been declining. So I think this strategy represented some great opportunity when that purple line was below the orange line. The blue line hadn't really risen yet, and that's kind of when we got into it. Now that purple line is significantly above the orange line, so I know that the fund is more expensive than at least one of its components. And the blue line, I think for good reason, is falling a little bit, and in large part, I think it's going to go in tandem with interest rates a little bit, at least in the short term. And the green line is clearly not doing us any favors. So we've done exceptionally well in this. I'm sure there's an argument to be had to continue to stick with it. I think there will be a better opportunity in the future to get back into it. Because of our change in our bond strategy, definitely influenced my decision on this strategy. There's a saying that you never go broke taking a profit. I don't necessarily always agree with that terminology, but in this case, I think it's the right move. So I also mentioned that we're going to decrease our credit risk a little bit on bonds. So if you look at that huge spike in the purple line, that's when we bought the fund, and that was when it's at its cheapest. When this line is high, that means the fund is cheap, and when it's low, it means the fund is expensive. And what we're seeing is that they're relatively historically expensive. The reason for this is because GDP is expected to do well for the foreseeable future. So there's good reason on why high yield bonds are expensive. Credit is available, but we did talk about how money is getting tighter and interest rates are going up, and those things tend to have a slowing effect on the economy. We did talk about how GDP has kind of two disparaging or different viewpoints at the Fed about where it's going to be in the next quarter. We could see a rather significant sell-off if it's on the lower end of GDP estimates. So, the fact that it's expensive, coupled with the uncertainty with the ongoing GDP, coupled with the fact that we're shortening up our bond strategy, leads me to believe that this is a reasonable place to reduce risk a little bit. So, takeaways, portfolio strategy implications. We're going to increase our exposure to mega cap tech stocks while decreasing the consumer discretionary position. Now, remember, we still like the consumer discretionary position, just not as much as we have. So we're going to start dialing it back a little bit. And we've been given a greater opportunity in the mega cap tech stocks. So we want to take advantage of that a little bit. We're going to take a little less interest rate risk in order to continue to derive the positive performance from fixed income. Fixed income's been negative for the average investor. It's been positive for us. We're going to continue to try to read the tea leaves to move the portfolio in a way where it'll continue to be positive for us. Because of decreasing interest rate risk, we're going to decrease our risk in our credit in our real estate markets, because we just want to make sure that we're taking the right risk and we're losing a little diversification benefit when we change our bond strategy. So those are the major takeaways. I hope that helped. That was the conclusion of what we had to talk about. And we have some questions that we've gotten recently from clients, and I'm going to share those with the group in case they are of interest.
In the meantime, thank you, Brian. Great job. For those who do have questions who'd like to pose them, there's a couple of ways you can do that. One is there's a Q&A box on that you can click on and type in your question. There's a chat area. You can certainly do that. Kathy is monitoring both of these possibilities. Or you can raise your hand if you'd like to ask a verbal question. Keep in mind, we are recording the presentation, and this will be available for others to listen to as well. So if you have any questions, feel free to reach out in any of those ways, and we'd be happy to address them. In the meantime, Brian, you mentioned that we have had a few questions that came up recently, both with an email or two and recent questions from clients. Maybe we can jump into some of those.
Yeah, so the first one was from a gentleman who's in our small cap strategy. It's a more aggressive, concentrated strategy that we have.
Individual securities, and it's not something all investors are utilizing.
Yeah, it's certainly not appropriate for everybody. And if you are interested in something like this, I think you should revisit your risk preference and your financial plan and talk with Chris or your advisor to see if it's appropriate for you. Now, the gentleman who asked the question has been in this since March, and his performance is down around 11%, which I don't love. Obviously, I'd like to be up 11%. But I think we need to review what I consider risky in this strategy. I wrote a kind of a marketing piece when I first developed the strategy, and in the marketing piece, I said that a drawdown of 25% should be considered the norm. That's the kind of base case risk I expected this thing to have. And I don't want people to think that this is only going to have return and not necessarily have risk. I think you need to stick with it for the long term in order to reap the benefits of the returns while also going through some bumpy patches.
It is a concentrated portfolio that has an impact on this, and it can allow for more explosive returns, but it does, when one investment has yet to perform, it can create drag. Additionally, I think to your point about you covered some of this in the content of your presentation earlier, but maybe worth just reiterating your outlook that there's still a lot of opportunity within small cap.
Yeah, I think there is opportunity. Here's the tough thing. Like, the stock doesn't know that I bought it, right? So I buy it typically because it's cheap. Sometimes it gets cheaper before it does what I expect it to do. And that's the reality for both our normal individual stock portfolio and our small cap stock portfolio. Now, specifically to the small cap stock portfolio, I think there are two stocks that are largely bringing down the performance of the overall strategy. One is the ticker is EBS, Emergent Bio. They ran into some tough press this year because they were contracted to manufacture both the J&J and the AstraZeneca vaccine. And somebody in a Baltimore plant mixed up the ingredients. So the J&J vaccine was on pause for a while because of that. The FDA had to go in there and reassess everything that they were doing. And there were many stories in the New York Times about this. AstraZeneca canceled their contract with them. So it wasn't good. Now, the stock sold off dramatically, but I thought the stock was well undervalued to begin with. And over the last 2 quarters, I've been monitoring what's going on with the company, right? There's a public relations risk here. But it's an industry that's not easy to break into. There's a kind of a general moat in contract manufacturing for drugs. And what I've seen is that their backlog has only gotten better. So they have so much demand for their product that they can't even fill it all. They have about $1 billion backlog. They have $1 billion on their balance sheet, and the company trades for under $3 billion. This is what we would call, by definition, a very cheap stock, I would think. Now, if we saw some change in their pipeline, that was dramatic. If we saw more cancellations of orders in their backlog, those would all be concerning. But over the last 2 quarters, where I think the worst news would have come, we haven't had the worst case scenario. Now, the stock's down, and we talked about how, Chris talked about at the top of the show how there's not a lot of tax cost harvesting opportunities in the market this year because the market's done so well. Well, this stock is a candidate for tax loss harvesting for the general investor. So what we typically see is when you get into the fourth quarter, if you've had a loss year to date, sometimes the stock gets pummeled even more. And we saw this in 2018. The stock market got pummeled even more throughout Q4 and then erupted as soon as January happened. So I'm not guaranteeing that could happen, but what I'm saying is stock's cheap and I still like it. I'm still personally buying it with my IRA money. If that makes you feel any better. The other stock that might be a tough one has been Smile Direct Club. Smile Direct Club. They make, if you're familiar with Align, they make kind of braces technology without braces. It's like a retainer type thing. They are biting off a lot. So what they're trying to do is they're trying to manufacture and distribute the aligners all at once. And their channels of marketing are varied, so they used to not be able to compete with Align, so they couldn't sell them through orthodontist office. So they had these Smile Direct Club things. So one of the reasons why I like the stock is if they can actually, integrate from top to bottom, they're gonna have a very wide moat. And the reality is, they're growing. Their growth slowed a little bit, but they're growing. But their biggest problem that they've had more recently is they had a cyber attack. And their cyber attack slowed down their production, had trouble getting aligners out to customers. It cost them actual money out the door. So their cash flow was hurt for the quarter. That's obviously a tough thing, a cyber attack, but it's really a one-time event. Hopefully they'll be able to clean that up and move forward from it. So these stocks can move pretty dramatically. They can move dramatically to the downside, but they can also dramatically move to the upside. The final one I want to address is a company called Bain Inc. They're basically the Shopify of Japan. They had a lot of revenue that pulled forward, and they had a lot of growth because of the pandemic, as you can imagine, similar to an Amazon. And now investors are a little unsure whether that growth is going to continue. And I'm less concerned about it. I think they're going to plateau for a little bit, and then the growth is going to continue. But these things take time. It's not just because I bought it doesn't mean that this is going to correct itself overnight. They need to perform, and when these companies perform, their stocks will follow in time. So the next question: I've seen a lot of trading lately, especially in the 60/40 strategy. Can you explain this? I want to remind people that we reassess our strategies every quarter, and then we write a letter. We talk about it on the radio station. We do these webinars, and the reason for that is because you're going to see a lot of trading. We're gonna reallocate the portfolio. We're going to rebalance things. So they typically happen in the third week of each quarter. For a variety of reasons, we're doing it a little bit earlier this quarter, partly because of earnings season coming up for the fourth quarter. But that's why you see some additional trading as of late. The 60/40 strategy is a smaller strategy that we have. It's tailored to have a little bit more trading. So it's not unsurprising that you see a little bit more in that strategy. How concerned should we be on interest rates rising? We talked about how when it comes to stocks versus bonds, this is like worried in terms of risk. It's like worried about skinning your knee versus going to the hospital. So keep that in mind. Interest rates can affect the prices of bonds. As we've seen in the last year, we've had a 1% drawdown in bonds. 1%, that's a bad day in the stock market. It's, in many historic years, it's a normal day in the stock market, but this year it's certainly been a bad day. So you shouldn't be too concerned about it. Let me worry about it. We'll continue to try to make small yield curve changes to try to continue to perform on the fixed income portfolio. As usual, people are concerned about taxes from capital gains.
Before you go on, Brian.
Yeah.
I want to just a little more before you go on to fixed income, or before you move on to other topics, rather. One of the things that you had hit on during your talk was, the reasons why you thought valuations were justified when it comes to the stock market. And we've talked about this in past quarters, that, even though the forward PE might look relatively high, one of the things we've talked about historically has been like the rising earnings expectations. As you talked about that a little bit, maybe slowing a little bit, but still encouraging. The other thing you've talked about in past quarters has been the fact that interest rates are so low, and how that can create some relative value, benefit to maybe willing to pay more for stocks. With the possible, where interest rates might be poised to rise over time, sometime next year, does that influence how we should think about what that PE we're willing to pay for stocks?
Yeah, so let's revisit it. Let's revisit this chart, right? So the right side of the chart shows earnings growth in the gray line the blue line is multiple growth, and the green line is the S&P price return. If we see rising interest rates and continued tightening of money, I would expect the blue line to continue to fall. And that's the multiple, right? But that can be offset by the gray line, which it has been this year, right? We've seen a pretty dramatic fall in the multiple growth, 10%, but the earnings growth has been so good that it hasn't, it's only been positive for the S&P 500. Now, if earnings growth stagnates and the blue line continues to fall, that would be a bigger issue. And that's something worth monitoring, right? So if the Fed continues to tighten money, but earnings for
I just thought that was worth having you reiterate for people that, even though, and if you go to the prior slide, it looks like it's a little bit extend. Oh, I guess it was way back, but the one I'm referring to. It looks like it's a little extended, but at the same time, given these other considerations, it still looks like it's a reasonable place to be. And you oftentimes will point out what you think fair value might be.
Yeah.
And we're pretty much right on where you had positioned things, saying where fair value might be as we got to the end of the quarter, we're there.
Yeah. So I don't think there's anything too surprising here, right? And hopefully this continues to happen, right? Where earnings growth continues to the point where interest rates can rise, and that's perfectly healthy for all markets, right? Your bond market, you'll reinvest at higher rates, and your equity market will continue to press forward because earnings have been so good. And that's the best case scenario, right? That's the balance that the Fed and the markets are trying to find.
Okay, thanks. I thought that was worth revisiting for a moment.
Yeah, definitely. So as usual, I'm concerned about taxes from capital gains. Now, one of the greatest value adds I think that we can bring as advisors is that we are constantly looking to take advantage of, find tax advantages for people. The reality is we've had such a good year. People have made so much money that there's not a lot of losses to take. Almost none at all. But I still want to avoid landmines, and I still want to take advantage of opportunities, which means that we've had some minimal trading. That coupled with the fact that there's trading I need to do because people need distributions. Sometimes you need money for a car or your general lifestyle if you're retired. Taxes capital gains become part of that scenario. And I just want to warn people that as we come up to the fourth quarter, and I'm going to remind you this for the next 3 quarters because you don't pay taxes until April, that you're going to have less losses to draw from this year than you've had in the past. And I think it's good to warn people about that in advance. So the most important question of all, what am I going to be for Halloween? I am not the kind of guy that dresses for Halloween. I never have been, but we got the cutest little duck outfit for my 1-year-old because she likes going to the public garden and looking at the ducks. She gets very excited about that. So we got her a matching duck outfit, and we're going to be bringing her to the zoo for the first time. And so I'm very excited about that. How about you guys?
That is awesome. No, hadn't planned on dressing up. Maybe go as a financial advisor, I guess.
How exciting.
Bad answer, I guess. But anyway, that's great. It sounds like a fun time with your little one. It looks like and Jeff is responding lame answer, Chris. All right, anyway. So with that, I think we're at about point. I don't see any more questions from our attendees. If you have questions or concerns, we're always happy to have you reach out. You can connect with us through our website, of course, amrfinancial.com. Reach out through client services at amrfinancial.com as a email address, or just give us a call, toll free 866-771-8901. Brian, as always, appreciate all the great preparation you did in this presentation. Any parting thoughts you care to share?
I just want to thank everybody for continuing to trust us. And please, again, as usual, don't hesitate if you want me to go into more detail about any asset that you own or any changes that we make. And thank you very much as usual.
Okay, and thanks Kathy for getting us all set up with our presentation today. With that, I'm going to wrap things up. Thanks, everybody.